So quite a number of people do ask, should you invest in bonds or real estate? Bonds or real estate, right? This is a comparison, and most of the time people are like, okay, what should I actually invest in? This is a very interesting question, and it's something that we should get deeper into. So I'm going to do a bit of an overview analysis to give you an insight into what you should consider. So obviously I can't tell you exactly what you should invest into from your own perspective, your own goals, your own objectives. You should know exactly why you're investing in something. So if you're investing in, let's say, bonds, there's a reason you're investing in bonds. If you're investing in real estate, you should have a reason why you're investing in real estate. And of course, all the calculations and all the logical decisions come after. But when you go into something, there are reasons. I've spoken about principles behind investing. I've spoken about objectives of investing and why you should consider where you're investing. There are many reasons you have to consider. Obviously, returns is a very specific one and a very big one as well, because anytime you're investing, what you're looking at is returns. You're looking at how much returns are you likely to get from that particular investment. I know when you're doing all the considerations, you're thinking of how much return are you likely to make from that investment, but that's just one of them. There are many other factors you need to consider. So when we talk about bonds and real estate, especially in Kenya, and I would say even in Africa generally speaking, what should you be considering? And if you just look at them from the perspective of returns, you'll be like, bonds would give me better returns. But let's look at that realistically in the next few minutes. Generally speaking, both investments are good, and you should have both of them. And you can have both of them. You don't have to choose one over the other. Now, the question comes when you want to buy something like a home. And that's where the discussion comes, because if you're buying a home is not going to be cash flowing. A home is not going to be really, it's an asset, yes, because probably you're saying you're not throwing away money by renting, but buying a home can be a liability sometimes. If you buy your own home and let's say you take a mortgage, especially in a country like Kenya where this is not properly protected, buying a home using a mortgage can become a very difficult choice. It can also become a very bad choice that could lead you into a lot of financial problems. And I've done a video on whether you should rent or you should buy, right? So make sure you watch that video. But if you decide that you want to buy a home, you must have good reasons why you're buying a home and at what point of your life, especially your financial life, right? So if you're buying a home, it's a different discussion altogether. And that's why we must put this whole discussion of bonds versus house into perspective. So let's say forget about a home, because a home then comes with other issues. A home is not really a cash flowing asset. You're going to live in it. You're going to make sure you're paying all the expenses that come with the house while not making any money from it. It's your residence, basically. So it's not an investment as such. It's just you buying a place where you live. And I always say, if you're buying it because you just want some peace of mind, or because, you feel you're at that time whereby you need to settle down and be, in a specific place, maybe you have a family, maybe there's a reason why you need to be, settled in a specific place, then obviously you want to buy a home. And it has to also fit within your financial capabilities. So don't go taking these large mortgages that you can't actually pay, and then you are left with something you can't actually afford. So it's very important that you consider all these factors when buying a home. But now let's say you're not buying a home, you're buying an investment, real estate. So you want to compare bonds as an investment, and you want to compare real estate. I've done so many videos on bonds in my channel, anything about bonds. So I'm not going to go into details of the basics of bonds, but basically bonds are IOUs. The government comes to you, they ask you for money, they tell you, hey, you know what? We want to ask for 1 million Kenya shillings and we will give you back with interest. They take that money, they lock it for a period of time. They're paying you every 6 months, basically twice a year. They pay you the interest that they promised at the beginning of that particular bond auction when it was being sold. So once you lock it in, you earn your interest every 6 months and your principal is safe. And at the end of that period that the bond is locked in, which is the maturity, then you get your principal money back, right, with probably the last payment. So in Kenya, we have two different types. We have the normal treasury bonds, then we have the infrastructure bonds. So the normal treasury bonds are basically, taxed at 15% withholding tax, and the infrastructure bonds are tax-free. I've done so many videos. Again, check my channel for all the information about these bonds. But depending on which bond you're looking at and you're comparing it with, it will be impacted somehow, right? So if you're looking at infrastructure bond, which is the IFBs, which are tax-free, and you're comparing it to real estate, that's a different discussion as well. And if you're looking at normal bonds, which is taxed, and you're comparing it to real estate, that's a different conversation as well, different calculation. And please let me know in the comment section if you want us to do this, get deeper into this analysis and kind of figure out what you need to actually invest in, and we can get into the mathematics of it. But today I want to give you a bit of an overview, right? So you can easily make this decision. So you have your two bonds, whether it is taxed or non-taxed bond. Then you have your real estate. what you want to do, the first thing is you want to know why you're investing in these two things. If you're investing in bonds, there are reasons why you're investing in bonds. It could be you don't want to get involved with the whole management around real estate, right? Real estate comes with a lot of management issues. You have to get your hands dirty, or you have to hire a management company to take care of your house and make sure that the tenants are, doing what they should and making their payments, the house is taken care of, all the things that come with managing a house. It just doesn't manage itself, and you have to maintain it as well. So that comes with the real estate bit. And then you have the bond, whereby you have no management, you have nothing to do. Basically, once I give my money to the government, all I do is receive my pay every 6 months and probably invest that pay or do whatever I want to do with it. Very easy, right? So some people just want that hands-off investment. If that's your objective, then perfectly fine. You've made your decision, you know where you want to go to. That's one way you could look at it. The other way you could look at it is somebody's looking for something that is not taxable, right? So you look for IFB, infrastructure bond, no taxed. In real estate, obviously, you'll be paying some taxes. So if that is your mode of comparison, then obviously you want to go for infrastructure bond against real estate, because you're going to be paying taxes, you're going to be paying land rates, you're going to be paying probably service fees, you're going to be paying maintenance as usual, you're going to be paying, there are lots of things you have to pay for as expenses when you have a real estate as investment. So in that sense, you're thinking, okay, here I have money that's just invested, I'm not paying any tax on it, there's nothing else I'm maintaining, there's no expenses on it, easy peasy. Here I have a real estate, brick and mortar, but then I have to pay all these expenses, I have to pay all these things around it, I have to make sure it's well maintained, I have to pay taxes on it. That's not a very good investment for me. So if that's your mode of comparison, then again, you know what you want to go for. Now, someone could also say, I want to go for something that I see. There are people who say, I want to go for brick and mortar. I want to go for something that I can point to, because again, they're saying if the government messes up with, let's say, domestic debt and they can't pay, then you end up losing a lot of money. You can lose all your money if the government fails to pay that bond, right? And somebody is saying, I don't want to take that risk of the government and knowing very well that Kasongo could wake up one day and mess up the economy and I lose my investments. I want to have something that even if the economy is doing badly, I can see my investment. Even if things are falling apart, at some point, people will need a place to live. And therefore, I can easily see that this is my house. Every single time, people will need a place to live. It doesn't matter what's happening. It doesn't matter whether it's COVID. Actually, in COVID, that's when you actually need more places to live. So in whatever conditions, whatever economic conditions, you have a place to live. Now, someone is saying that's what my comparison foundation or comparison bar is, then you want to go for real estate. Someone is saying, I want to invest in something that I live for my family. I want to create proper wealth, that is, rooted properly. And again, that's something you want to build in real estate, right? Real estate is a very good wealth conservation tool and very good for inheritance and stuff like that. So again, in that sense, okay, bond is more of liquidity and this one is more of wealth conservation. If you're going for wealth conservation, you're going for real estate. Someone says, I want to get something that cash flows me consistently forever. I don't want to be worrying about, maturity is coming up and therefore I will need to worry about interest rates are changing now. What do I do with the money? They want something that is set. Their cash flow is set. Again, they go for real estate. Someone could be saying, I also want an assured amount every single time I'm paid. Then the bonds will be the best one for that, right? Because with bonds, you know how much you're going to be getting all the way. So let's say you take a bond for 25 to 30 years. You know exactly what you'll be making every 6 months and it will be in your account on that day. There's no doubt about it. In real estate, of course, we have vacancy loss. We have, times when there are no tenants. We have times when the house is not livable, it's not rentable. Maybe there are issues with it. We have times when you have to do maintenance in the house and therefore you won't have a tenant at that time. We have times when you'll have vacancy. You can't be sure that you will always have someone living in that house, especially if an investment, right? Even if it's a commercial property, you can't be sure it will be always rented. So in that case, you have to factor in that vacancy loss. Someone could be saying, no, I don't want to worry about the fact that, yes, I have an investment, but I don't know when I will have money and when I won't have money. I want an investment that I'm sure I will get money. You go to bonds, because in that case, bonds is a good option for you, right? So it depends on your objective with that investment. And that's the most important bit. Someone could be saying, I need the security of the government because I know the government will always be there. The government will always pay. The government will always make money. People are paying taxes. They can print money. They have lots of money. It's a rich entity. So I want to do business with the government. Again, in that case, you go for the bond. And because real estate is a private thing, and there are also risks around these things. There are risks around debt securities like bonds, and there are also risks around real estate. You could buy land in the wrong place. You could buy a house in the wrong place. You could buy the wrong type of house. You could buy a house and then prices, come down rapidly, the real estate sector could also collapse, especially in Kenya, whereby the real estate prices are like properly ballooned for no real value, to be honest. They're like out of their value. It's crazy because one day it might come down. So you want that security of like, okay, I want the security of the government. I don't want to take the risk of real estate. Again, you decide on what you want. So these objectives will determine which should you invest in. Again, someone could be saying, I want to balance out my portfolio. In that case, I want to have some bonds. I want to have some real estate so that I'm balancing out my risks, because there are also risks of the government defaulting. There are risks with bonds. There are risks of interest rates as well, falling in a way that you didn't expect. While, with real estate, it will be, constantly giving you the same cash flow over a period of time, and especially it could even be going higher and higher. So these are some of the factors you want to consider. These are many factors you want to consider. There are more that you'd want to consider before you invest. Now let's go to the returns, right? The ROI. What is your return on investment? So in Kenya, for instance, right now, we've had very good run until late last year, when we had bonds giving us up to 16, 17, 18%. So if you invested, let's say 1 million Kenya shillings into a good bond, right, and someone is giving you 18%, that's 1 million times 0.18, you're getting your 180,000 per year, right? If you divide that by 12, you're getting your 15,000 per month. That's cash flow. That's money that's coming to you every single month. Of course, you will be paid every 6 months, but exactly how much you'll be getting. If that bond is, let's say, 20 years, 25, 30 years, you know exactly how much you'll be making throughout that bond period, right? So 1 million invested, you get 18%, no taxes paid, you have your 15,000 per month as cash flow, guaranteed money, right? Now you can say, okay, what about real estate? Now with real estate, it's a bit more complicated, right? You're looking at many things. You want to calculate your ROI on real estate. You want to look at what's your purchase price, right? How much did you pay for the house? You want to look at what is your rental income, annual rental income. And then you want to look at your expenses, because you won't just be, having this rental income without expenses in the house. So you want to subtract your expenses from that rental income. Once you do that, then now you want to divide that by the value of the house and multiply by 100% for you to get the ROI for sure. So the other one was an investment for 1 million. Now, for us to get the right figure, guys, let's do 10 million, right? So let's say it's 10 million, because most houses in Kenya, if you get a nice flat right now, we're talking about 10 million, 10 million, right? Houses are like crazy right now in Kenya. So let's do the other calculation we did with 10 million, right? If you do 10 million and multiply that by 0.18, 18% return, that is last year, that is 1.8 million per year, and divide that by 12, you're getting 150,000 per month. Now, if you divide that by 2, you're being paid 900,000 every 6 months, right? 900,000 every 6 months. Again, like I've said, if you're doing it by 12, just to see how much you're cash flowing every month, you're getting 150,000 per month. So with a 10 million investment in bond that is not taxed at 18%, which was like last year, you're getting 150,000. Now the rates have gone down now, right? So let's be realistic and say 10 million. So 10 million multiplied by 0.14, the latest bonds are around that. That gives you around 1.4 million. Divide that by 12, you're getting around 116,000 per month. If you divide by 2, you're getting 700,000 every 6 months, obviously, okay? So that's if you do IFB bond 14%, which is around where we are at the moment. You're getting 700,000 every 6 months, and 116,000 Kenya shillings every single month. That's a bond, right? Now with the real estate, like I said, you have the value of the house, which is like 10 million. Let's say you buy a house for 10 million. Let's say this house for 10 million is giving you, it's a very good house, good location, is giving you 150,000 per month. 150,000 per month, it means in a year, you're making 1.8 million as well, right? So almost similar, but actually even higher. But again, I'm being very generous with the rent. Actually, you know what? I think I'm being too generous. Let's say the house is giving you 120,000 per month. That's realistic. 120,000. It's very difficult to do real estate calculation, especially with so many factors affecting real estate. But anyway, 120,000, you're doing it per year. Your rental income per year is 1.4 million, right? The house is at 10 million. That's how much you bought it for. 1,440,000 is your income per year. But remember, you have expenses. So let's say you're not spending much in the house. You're only spending an equivalent of 1 month's income, which is 120,000. You subtract that, like 1,320,000, right? That's your income, your net profit of the house. You want to divide this by the value of the house, divide by 10 million, and then you multiply that by 100, and you have your return, which is 13%. Now, 13.2%. Now, with 13.2%, if you think about it, it's quite, I would say, good return in most cases. But real estate in Kenya, looking at the history, has been around 10% or up to 8%, actually 8%. This seems too generous in my opinion. So 13% seems really high, to be honest. Like most of the time it's around 10%, 8%, between 8 to 10%. Mine seems really high. Now, if you're looking at 8 to 10% on your return on your investment of 10 million, you're thinking it's low. But with real estate, you haven't calculated the appreciation value, which again can range depending on many factors. Most of the time when you do your research, it shows that it can appreciate between 8% to almost 20%, right? In that range, it can be 8%, 9%, 10%, whatever appreciation value. But again, depending on where you bought the house, what's the location, what's happening there, like how is the environment. There are so many factors you want to consider for you to figure out what the appreciation level is. Because you can buy a very nice house, very expensive house, but it doesn't have enough room for it to appreciate. And someone else buys a very, affordable house, maybe even off plan, and then the house has like loads of room to appreciate. And that's something you need to consider before you do your calculation. So someone might have a house that's cheaper, but the appreciation level is way higher. Someone could have a house that's expensive, but they don't have any room for appreciation. So in that case, you want to consider that as well. But looking at the appreciation level of that house, again, we'll consider how much you're going to make at the end of, let's say, 20-year period, right? And so if you look at these two calculations, it's hard to actually compare them like by like, but to some extent we can. For me, I think it's more to do with the objectives with regards to investing. Let me know in the comment section if you want us to go deeper into this discussion and do some calculation properly and get to the real figures. Because right now we just see the cash flow in terms of what you're getting, right? You're getting your, let's say, 13% return, while the bond is giving you 14% return, but you haven't calculated all the other factors as well. So in this case, real estate is still giving you a bit lower, obviously. Bonds giving you a little higher than that. Actually, if you think about realistically looking at the historical returns, real estate will be way lower than bonds in this case. But like I said, with real estate, you haven't calculated certain things. And again, there are risks involved in both areas. So how much risk are you taking while you're investing this much in real estate, and how much risk are you taking while investing so much in bonds? Those things all need to be weighed out. This is like an overview analysis. We can get into detailed analysis of the mathematics behind it. If you tell me you want that, let me know. I'm out.